The following programming is sponsored by Tom Toole III. The views expressed do not necessarily reflect the views of this station, its management, or Beasley Media Group.
Good afternoon, Greater Philadelphia area. This is Toole Time Real Estate Radio on WWDB 860 AM. I'm Tom Toole. She's Stacey Mitchell. She's Sarah Tymon. We've got Gabe behind the camera, and we all work with the Tom Toole Sales Group at RE/MAX Mainline, the number one RE/MAX team in Pennsylvania since 2018. And there's been a lot of news in the market about what's going on in the industry, more opinions coming out about the housing market that we're going to discuss here in a second, and we're going to start there. And there was a couple things that had kind of come up that I found pretty interesting that got released on CNBC over the past week. So the first one, home builders are saying the U.S. is in a housing recession as sentiment turns negative. What do you two think about that?
You mean specifically about new construction?
I mean, housing recession sounds pretty broad to me.
Yeah, that does. I think that, again, as we've touched on before, for people that need to move, they're going to make that transaction happen. I think that we have a couple other factors that are going on right now that are actually making it a lot more favorable as a buyer to come back to the market. Obviously we need sellers there in order to be listing their homes and having opportunities for the buyers, but we are starting to see that tick back up.
So I think for new construction, it could be a little bit different. Maybe that's where they're trying to get these, or they're pulling this information from. Home builders are saying they're in a housing recession. The cost of materials for a while there were super exorbitant because of the supply chain. But I know things have come down. They're probably not down to pre-COVID pricing by any stretch. But in turn, the pricing for the housing for the new construction has gone up. So that should have balanced itself. And I do know in our particular area, the new construction doesn't last. They go under contract quickly and they're sold out. You drive by new starts up on 322, sold out. There's a new one coming up in outside of Coatesville for 30, and they're already starting to sell like crazy because it is an affordable price. I think they're all below 400. I think some, to start. So, and lower. So I think that with some of the new construction, maybe some builders pulled back a little bit because, just the costs of their materials. But what we're seeing out there, it seems to be still pretty robust in our area.
Well, and what concerns me about this is that when they say there's a housing recession, I mean, I don't agree with that at all. We've talked about this at length on the show here. I do agree new construction's probably impacted more than any other segment of the market because, like you said, they're actually buying the raw materials. Inflation's been an issue. Supply chain's been a real problem. It seems to be getting a little better. I don't know if it's that great. I mean, it still takes forever to get things, and it's shipping containers are constantly sitting in the middle of the ocean for no reason. So there has been a decline in that, and they actually put a number on this. So they have a National Association of Home Builders or the / Wells Fargo Housing Market Index. It dropped 6 points to 49 this month, and it's the 8th straight monthly decline. And this scale that they use, anything above 50 is considered a positive, and it hasn't been negative since the brief plunge at the start of the COVID pandemic back in 2020. So I think that has a little to do with it. I still don't see housing recession, though. And Sarah, you mentioned there's more favorable things happening right now. There were our friends over at Keeping Current Matters. They put together a couple slides that we can probably show on the replay here. One of them talks about what's happening for buyers currently. So in April, we were seeing an average of 5.5 offers on a home. In May, it dropped to 4.2 offers, and in June, it's 3.4 offers. And this is a national number. We've also seen that fewer homes are selling above the asking price, 61% in April, 55% in May, and 51% in June. And nationally, the supply of homes is growing, rising from 2.2 months supply in April, 2.6 months in May, 3 months in June. So that to me is an opportunity, not only for buyers, also for sellers that need to find a home. Everyone forgets the sellers need to find a place to go, and this really affects them. So, I get the new construction part. I'm just not seeing it in the market. I don't know if you two agree or disagree.
I totally agree with that for sure.
Yeah, absolutely.
Yeah, I don't like these negative headlines that come out because we have to do so much cleanup in aisle one of, whenever there's all this negativity about, the housing market. And we're just not seeing it in this area.
Yeah, I'd agree.
I mean, I argue it's irresponsible journalism. I mean, this is CNBC. This isn't some fly-by-night news network here. And if you look at the home price forecasts for 2022, there's Fannie Mae, Freddie Mac, NAR, the National Association of Realtors, Ivy Zelman, CoreLogic, the Home Price Expectation Survey, and MBA, the Mortgage Bankers Association. Besides the Mortgage Bankers Association, everyone else is predicting a 9.3 to 16% year-over-year increase in home prices. The Mortgage Bankers Association is at 2.7%, which would still be fine in a normal market, which is what we're entering into. And the average of all 7 is 10.3%. And that's actually up from last month, where the average was 8.5%. So I just don't see this housing recession. I think home building is it's almost a different industry in a lot of cases, especially where we live, because how much new construction is really out there?
Not a whole lot.
Right.
Not in, yeah.
There's
there's pockets.
Yeah.
Right.
Well, and with that being the average at 10.3, that's still double what was like a normal growth rate, pre-COVID, which was usually coming in somewhere around like the 5% range.
If someone said, Sarah, give me all your money and I'll give you a 10.3% return year over year, what would you do?
I would take it.
Take it? Yeah. That's my point, though. I mean, I don't think there's anything that's like, this isn't overcomplicated or overly complicated. A lot of folks are just, they're constantly talking about all the negatives happening in housing. This is just a normal market. That's all I'm really seeing. So it sounds like we're all in agreement there. And then the next part of this is Grant Cardone is at it again. So if you don't know who Grant Cardone is, read the 10X Rule. Great book, by the way. Love the book. He had an article that was published on CNBC. It's on their Make It section of their website, and this was last Thursday. And he said, don't buy a home unless you can afford to waste money. And he goes on and on about how your costs eat up your profits. No cash flow makes you dependent on the market. There's limited tax benefits compared to commercial real estate. So, and he just says, my opinion, don't buy a home unless you can afford to waste money. I have a real hard time with this article.
Like, what does he call renting? Like,
right. And like, what do you mean don't buy a house unless you want to waste money? What does that even mean? This whole article just blew my mind. I couldn't believe it.
And, he actually says he owns his own home. And
right.
then he has a investing network where people can buy into the investments he makes to get a predictable return. Mm-hmm. And I guess the only point of this article that I kind of understand is that he's considered to be worth, I just Googled this, $2.6 billion. So at $2.6 billion, buy commercial real estate, you're going to get a better return.
Right. I did think that was interesting that little section was in there for, why you're wasting your money. And it's like,
right.
For your average person, like commercial real estate, like it's
not even in the realm.
That's not even in like what we're talking about here. Like,
right.
Sure, if you've got that much money, then go commercial. But for your average consumer, like that's not.
It's not even.
That's not even on the page.
And he tells them to rent, which is probably.
Well, you're just making someone else. You're making his
right.
payment, so that's why he
Yes.
wants you to rent.
Right.
And I have such a hard time with this because I like a lot of the things that Grant says from like a business building perspective. The 10X Rule, great book. He's written a lot of great stuff. The realities are this: the average net worth of an American household is $748,000 and change. He has $2.6 billion. So congratulations, great. That's great. I'd love to have $2.6 billion as well. But then he talks about the limited tax benefits compared to commercial real estate. So he specifically mentions that you are limited to how much interest you can write off on your home, and you're only allowed a tax exemption of one $250,000 gain on the sale of a single-family home every 2 years. The average time people are in homes right now is 11 plus years. Mm-hmm. And if you're looking at a $250,000 gain. If the average net worth of a U.S. household $748,000, then they're probably not. I mean, I would argue there might be some people now that are on the lower end of that have seen that kind of gain because of what the market's done over the past 2 years. But he's not talking to the average consumer that's out there. And then when this stuff gets posted, you get people thinking all these crazy things. And I actually equate this to like Dave Ramsey, where he's like, pay off all your debt and then save up to buy a home. And then people have no money to buy anything, and they're paying off credit card debt that's like $10,000. It takes them forever to pay off. Mm-hmm. Not saying debt's great. It's just these strategies they're not a one-size-fits-all strategy. And when this stuff gets posted, it just gets in the consumer's head, and it hurts their ability to make logical decisions.
Right. I agree. And the breakdown of his math here, 10 years of interest at 6% each year based on a $100,000 investment. He goes into this math equation where he says your total cost before maintenance, it would be out of pocket would be $86,000 on your $100,000 investment. So he's basically saying that over 10 years, your investment returned 1.4%. But he's failing to talk about you have to live somewhere. Right. So let's do the math on if you pay rent for 10 years and what that's not an investment. So I'm not sure. I just don't understand this whole premise, because if you're telling people not to buy a house because you're wasting money, obviously you're not. You're still, based on his math, you're getting a 1.4% return, which, okay, maybe it's not great, but you're living in the house.
Right.
Okay. So you have your shelter. It's an investment, right. And if you do sell it, maybe that would be your return. In this market, it would not. It would be tremendous return.
Right.
So I still don't see where that's a big fail.
Right. And then his next point goes on saying that no cash flow makes you dependent on the market. Well, and that true real estate investments provide you with monthly passive income. Well, yes, if you've got income producing rental properties, right. But for your own personal home where you live, where you're paying a mortgage payment rather than a rent payment, I don't think that having the passive income makes it a success or not a success. You know, it's when you go to sell it that you turn your profit.
Right. So it would be kind of, I don't know, it's kind of a wash. If you have a rental property, but you're renting for your place, for your residence.
Right.
What? I don't get it. I'm
right.
not understanding that.
Right.
Well, and for someone like him, he may want to live somewhere for a year or two. Well, then I wouldn't buy that house either if you're only going to be there that short term, because he's probably buying something that's, on the highest end of the premium market. So that's a different story. But this is not realistic for what a lot of folks are doing. So I just pulled another, and this is actually on CNBC. So this is August 24th of last year. They did a survey of the consumer finances, and they had a very different net worth number. They said that the median net worth, which is different than the average. The median and the average are two different things. The median is the middle number. The average is the average of everybody. So the median net worth is $121,000 for a U.S. household, and in 2019, homeowners in the U.S. had a median net worth of $255,000 versus just $6,300 for renters. So that tells you all you need to know. I mean, when we're talking about the average person, the average American, that's a 40x difference between the two groups. So, he's Mr. 10x. Well, he just got beat by a factor of 4, as far as I can tell, on this on this math here. So you just got to be careful who you listen to. And I think the lesson here for consumers is that you can make stats say anything you want. Mm-hmm. You talked about having to do cleanup cleaning up like what was it, cleanup on aisle 10 or something you said. I love that, because people see these articles and then they're like, oh, well, Grant Cardone said this, or, so-and-so said that. And then when you actually break down the math and show them, it's very different. And to me, this is all the more reason to find someone in your local marketplace that can help you navigate these things. Because, look, our market's a lot different than other markets. You go to New York, like New York City, right? Like, imagine, compare Philadelphia downtown to New York downtown. The cost of housing is just dramatically different. So, yeah, you shouldn't buy New York because you can't afford it. Here, you can hold on to it. Value's going to build. You get tax benefits. You're not paying someone else's mortgage. Yep. Or it just doesn't make sense. I mean, you're not wasting money there. I would argue you're doing the opposite. Now, the flip side is, I don't know that a house, like buying a house is like you should be your retirement plan. I think that's where some
Right.
people go wrong too. So,
Right.
you know, we're not financial advisors. This is just what we've seen in the marketplace. So to me, it's all about getting some local advice on what's going to be relevant to your market.
Right. And he also goes on to say he doesn't believe that owning a home should be considered as the American dream. And I don't understand either. The folks that I deal with daily, it is their American dream. You know what I mean? It is their dream. He says, for the most part, it's simply a place to live. Well, yeah, you have to live somewhere, but it's more than that. It's people have their families there. They make memories there. You know, the houses that we go into, you open the door, and on the door frame, you see where the kids have marked their growth year to year.
Right.
You know, that means something.
Right.
It's not just a place to live. It's a place where you are living.
Right.
You know, so it is an American dream. It's a dream for most folks to own their home that they live in.
Absolutely.
Well, a lot of the American dream, it's called that because you can't do this in other countries. Like owning a
Right.
home in other countries where a lot of people immigrated from, like it's just unheard of. It just doesn't happen. So, you know, both of these are examples of just being very careful about what people are saying about the housing market right now, because with the stats that I shared, 10.3% year-over-year appreciation, less multiple offers, and still 3.4 offers, which to me is pretty incredible because I've been in markets where there's no offers and you're just waiting, and it's the time on market's like 90 days, 120 days. I mean, to me, that's tremendous for home sellers. And even our supply is lower than the national supply. We're about a month and a half here in the Philadelphia suburbs, about 2+ months in the city. We're less than the 3 months that we're seeing nationally. Still incredible because an even market's not until you get a 6-month supply. So you would have to double that nationally. So I see a lot of positives about the market, and the silver lining here, and this is actually from an economist quoted on CNBC. This is on Keeping Current Matters. His name's Joel Kahn. I don't know if I'm pronouncing that right. Joel Kahn, I guess. I don't know. There could be a potential silver lining for the market as stabilizing mortgage rates and rising inventory are bringing buyers back to the market during the second half of the year because so many people got scared off by stuff like this.
Yep. And they realize this is how it's going to be. Like the interest rates are going to be there.
Right.
We can't control that. Let's
Right.
focus on the things we can control. You know, we can control you going out and looking at homes and putting offers in.
Right.
You know, let's do it. We
Right.
can't control what offer the seller is going to choose, but you can throw out your best.
Right. If you don't try,
It's
don't
not
have a
going to
shot.
happen. Exactly. We know that.
Right.
That's a proven fact. If you
Right.
don't try, you're not going to succeed.
right. Right.
So yeah, you got to get out there. And I think that buyers are coming back into the fold because they realize, okay, you know, they went up and then they dip back down. Let's just get in. Let's just get in the market here.
Right.
Well said. So we're going to take a quick break. We're going to come back. We're going to talk about not surprising real estate news and also very relevant real estate news. This is Toole Time Real Estate Radio on WWDB 860 AM.
You shouldn't have to deal with all the red tape when getting your mortgage from a big or online bank. At Mortgage America, we have access to big bank money, but with the personalized and detailed service of a local bank. We are here in your community and ready to serve with fast settlements, low down payment options, and first-time homebuyer programs. Pre-approval is free, no costs or commitments. For more information, visit our website at mymortgageamerica.com or give us a call at 610-439-8000.
Mortgage America's equal housing lender. NMLS 128501.
The Tom Toole Sales Group is the #1 RE/MAX team in Pennsylvania with over $165 million in volume for 2021. I'm Tom Toole, and our team has achieved that kind of success by being a great place to work with and to work for. No one knows Greater Philly better than we do. We know real estate, but more importantly, we're real people. We hire the best agents, and we give them all the tools to succeed. Even our brand new agents sell 17 to 24 homes a year because our team delivers the best experience in real estate. Teams deliver a better experience than individuals, and we're a top 1% real estate team in the country. We call it AAA service. We're your advocate, ally, and advisor. Because this isn't a transaction to us, it's a relationship. If you're buying or selling a home, call the Tom Toole Sales Group at RE/MAX main line at 610-692-6976 or visit tomtoole.com. That's tomtoole.com. Sell your home for more, and remember the real estate golden rule. You always get more when you work with Tom Toole.
Buying a home or already own one? We can help. I am Kevin Hamill from Alliance's Insurance Agency. If you haven't reviewed your policies in the last 3 years, now's the time. New home buyers, there are a number of ways that we can help you get to that settlement table. Call us to find out more at 610-816-0043, extension 3, or visit our website, alliancesinsurance.com. Don't forget the S, it's for savings.
Have you considered a career in real estate? Do you want control over your income? Whether you have a license or not, call us today at 610-692-6976 or visit tomtoole.com. Join our team, the Tom Toole Sales Group at RE/MAX Main Line. Welcome back to Toole Time Real Estate Radio on WWDB 860 AM. I'm Tom Toole, she's Sarah Tymon, she's Stacey Mitchell, and we've got Gabe behind the camera, and we all work at the Tom Toole Sales Group with RE/MAX Mainline, the number one RE/MAX team in Pennsylvania since 2018. And this may be the least surprising story industry-wise that I've seen. However, it's super relevant because this run of the market's so hot, we're going to do whatever it takes to compete is ending for a lot of companies. We've seen a lot of companies, both in the mortgage industry and in the real estate brokerage industry. They've changed their comp plans. They've cut staff. So the most recent news, this dropped yesterday, is that Compass announced Monday that they're ditching its recruiting perks, specifically signing bonuses and stock options for any new folks that sign on with their company. So they're and when I say signing bonuses, I'm talking about, I think Randy Moss put it best, straight cash, homie, is what he says all the time, right? So they were, this was happening at a high level, and this was on their earnings call. They're ending these equity incentives, and they actually ceased them 2 months ago, and the financial incentives ended last week, and they're all going to be on the same commission split. So what do you make of all this? Because this is a drastic left turn from a company that said, we're going to keep going, we're going to keep doing this. This is how we operate. We're the fastest growing brokerage. To me, it's all about having a healthy company, not being the fastest and the highest agent count. What do you two think about all this? And I think this raises some other questions I want to get into.
Well, I think it means that they're feeling the shift going on. Mm-hmm. Honestly, I don't know anything about their structure, the way that they're made up. I don't. So I don't know what they were offering as far as stock options or bonuses. Are they, what are these bonuses that they speak of? Is it something that incredible that some people would say, oh, no, if they're not giving me, the 30,000 sign on, I'm not going. But it looks like they're expecting to save $320 million. I guess that's annually.
That's probably a good thing since they lost $101 million last quarter.
Okay, so this is what the true true story is, their losses. But I know that with Compass, they came out really strong with being the technology company and being up to date on all the peripherals, I guess the systems and lead generation, things like that. They're kind of trendy and cutting edge, supposedly. That's the kind of the take I get from Compass and how they were trying to attract agents. Mm-hmm. But yeah, I think that they're feeling the shift, and they're kind of getting nervous, so they're going to pull back. And what's the first place they pull back? They pull back on those perks.
Well, there's also after they've laid off a lot of people, too. I mean, they've cut a lot of staff. They've cut their tech people. So, I mean, this to me is, and I'll jump in here. I want to hear what you have to say, Sarah, too, is that what concerns me about companies like this is they don't keep an eye on the bottom line, and they're like, we're going to grow, and we're just going to outpace our costs. And to me, that's just a failed business strategy because there's so many companies like this that never make it into the black, and their stock prices when things were running well even a year ago. Now their stock price has never done well, but let's look at Zillow, right? Mm-hmm. Zillow just became profitable not that far off ago, and their stock price went up and down, up and down. So and this is a Wall Street problem. This isn't. I'm just using Zillow as an example. That they're only and the backers behind Compass at the bank. What's it called? The Saudi bank that backed WeWork. Killing me here. Anyway, WeWork had the same problem. They went under, right? So it's I think this is a dangerous model that people are using, which is we're just going to outpace our spend instead of have a business at the beginning and then kind of expedite your growth once you have some infusions of cash through profits. And I think that's more the traditional model that people kind of forgot about.
Yeah, I mean, I think it also said, they didn't feel that they were going to have any problems still getting agents to come on board with them. I would assume that they would be, in that case, then getting new agents that aren't switching from a brokerage that they're already in to switch over to Compass. And I feel like it's one of those where for agents coming up that then join Compass that didn't know any different, like they never, either they weren't aware or it was never on the table for them to get these different bonuses or stock options. If other companies aren't really offering them either, they would probably still be likely to join onto that team if it felt like a good fit. Versus I think one of the ways that they were able to get a lot of agents that were already experienced was potentially by offering some of these different options that were enough to get people to switch over. So I think that the influx of new agents that they'll see coming on and joining their teams will probably be newer agents.
And I do agree with that to a certain extent. All they've done is add experienced people. They haven't, and they've gone in. They expanded to 62 markets, or they were in They went from 62 to 71 markets in 1 year, and then they went from 9 to 9 new markets in 12 months. And they were trying to come in and just open these offices up, and it costs money. I mean, where they have their offices, I mean, they have an office in Suburban Square in Lower Manhattan. That's probably the most expensive retail rent on the main line. I just don't see the need to be there. I don't think you need an office like that to do business personally. I mean, you guys saw where we used to work, right? I mean, before we moved to our new place, I mean, let's be real. I mean, it wasn't the sexiest office, but we were able to do what we needed to do. So what concerns me about this is more the agents that went there and they maybe got sold a bill of goods, and now all of a sudden their stock's down 74% that they signed on for. Anyone that took the cash as the reason going there, I've got questions about their business model more than anything else. If they're like, well, I need this. It wasn't even as much as 30 grand in some cases. It was lower than that, and also much higher depending on the volume of that these teams did that came over. So this isn't surprising, and I guess the question I have is, for agents coming on, would you be more, and you guys have both done this, would you be more concerned about incentives, or would you be more concerned about how you're going to grow your business? Like, what would you recommend for people that are thinking about making a switch or a new agent getting into the business? What should they be looking for? Because to me, it's all about how do we help people? Because once you move, I think you kind of cast your die in a lot of cases, and you're going to, at least you should stick it out. I don't think the people that jump around never do that well.
Right.
I think that for new agents, if you have absolutely no background at all, like no experience, especially there's a lot of new agents that never even purchased a home.
Mm-hmm.
That is true.
So you don't even know the experience from that side. For new agents, if you have no clue, I would highly recommend that you need to look into a firm that's going to bring a lot of training, mentorship, people that are experienced on the team that are willing to, be there as a group. I mean, a team is just that. It's a team.
Mm-hmm.
And I know when, some of these broker firms, you can come on as an individual agent. I don't even know how you would.
It's rough.
I just
been there, done that.
Rough is not the word. I mean, that's really, that's something. But, the teams, especially I know from our team, I don't know from my own personal experience, starting out as a new agent, even though I do have experience on the buying and selling side of it, just personally, I still don't know how you would make it. Like there's the systems that are in place on our team. There's so much advice. There's so much skill building. Everybody's a team player. So I think that's so valuable. If you're a new agent just getting involved, all that experience is thrown behind you, and it can really set you up for a really positive experience in this building your business, as opposed to you getting frustrated, you not getting answers, you're out there on the island by yourself, and you're just like, what the hell am I doing? I don't even. And that's why so many agents get out of this business.
Yeah, there is a high failure rate.
Yeah. Well, I mean, it makes me think of that little saying of, if you give somebody a fish, they can eat for a day. If you teach them how to fish, they can eat forever.
Yes.
It's you have to think longer term and what is going to help you really build your business and be able to sustain the shifts in market and, all the changes that happen. Sometimes it feels like day to day, but like certainly you see it in like weeks and months and seasonally, and you have to know how to work around all of that and how to be able to help yourself.
So I agree with both of you on that there's got to be some sort of like training program, some sort of mentorship, some sort of resources. And what I get nervous about when I hear this stuff, I'm a big believer in, if you ever read the book Good to Great, I don't know if you guys ever read that. It's about like companies that have outperformed the market average by like 6 or 7x. And they're big believers in the flywheel concept, which is everyone going in the same direction. And it's like a slow buildup. It takes momentum to start moving things. And that's the companies that always outperform the competitors. So think of Circuit City in the 80s. Like that really outperformed the other competitor that was, I don't even remember the name of the company.
Radio Shack. No, I don't know.
It wasn't. It was something like Radio. I always forget the ones they compare it to, but Circuit City was this like force of a company that was out there when it came to electronics, and there's others like that where they look at the average industry and these companies outperformed it by like 6 to 7x in terms of rate of return and profits and business they were able to do, and they all believed in a slow build up, sticking with the process, and just staying consistent and keeping things simple. And then they have another philosophy called the doom loop, which is the comparison companies. And they try to jump right to results. And like imagine, and we've seen this with even people in the industry. They come in and they're like, I just want to go sell homes. I'm not going to do the other stuff. And then they never sell anything. So they jump right to results. They try to spend their way to success. They don't believe in the slow buildup. And they're constantly pivoting strategies instead of sticking with one thing that works and keeping it simple. And unfortunately, the latter really describes what happened here, where they've constantly shifted strategies. It used to be about tech, and our tech's better than everybody else. I don't think anyone has any better tech in real estate than anybody else. They're all pretty much the same. You got to stick with the one you're going with, right? I mean, if you learn to work your systems better, they're even more. I mean, I know like we use the Boomtown CRM. There's stuff in there I'm sure I don't even know how to do. And I think all of us could probably say that. That's going to help our business, right? There's more things we can use to do that. So they're shifting strategies. They're constantly pivoting, and everyone's kind of going in a different direction here. And that's the companies that have this looks like it's a meteoric rise, but then they come crashing down. They don't have sustained success for a long-term period. And unfortunately, I see more of a doom loop scenario here than a flywheel with Compass, because they tried to come on the scene and grow so quickly with the SoftBank money. I remember the bank. And it didn't go well with WeWork. I mean, WeWork was a disaster what happened with them, and that was another SoftBank investment. So, I mean, it's unfortunate, and I wouldn't be surprised if someone buys Compass, meaning another company. I think that could really be on the horizon here because their stock price is so low. I mean, 74% in a year. I mean, that stinks.
Yeah.
Yeah, and it's also concerning on the investor call. It's quoted as Refkin saying, never in my time at Compass have we seen such a big downturn in a short time. That's kind of scary. And he described the future as uncertain. So that is raising alarm bells. Like, oh, okay. It's like that.
So many people are talking about the downturn has been unexpected here. Was this that unexpected for you two?
No, what comes up comes down. I mean, it can't be peaks all the time.
Yeah.
Right.
Mm-hmm. Yeah.
I mean, I would argue we kind of almost predicted this was going to happen and had been training for it because, we've seen the signs, and you kind of have to look for the signs early and pivot your strategy earlier and not just totally go away from it, but hey, what was the stuff that we did that we maybe need to recommit to, like buyer consultations or overqualifying people or just talking to more folks, not just running with the people that follow up, right? I mean, unheard of in real estate. So, I do agree with that. And I mean, what kind of confidence is that inspiring the people that work there? Like a lot of people made this move because they believed in the CEO. I mean, I'm not seeing that there's this dramatic downturn. To me, this market is full of opportunity.
Totally full of opportunity. Yeah. I think the one and done, it could be on the outs,
Right.
And that was the easy pickings.
Right.
Like you have to take
that
people
would never
out
happen before. I've been doing this 21 years. I think that happened to me 3 times.
Okay. So see,
I mean, it was not often.
Mm-hmm.
And when it did happen, I'm like,
wow,
this is awesome, but
Right.
it's not a common thing.
Right.
Where some new agents that just got into the biz could think, oh, this is the way it is.
Mhm.
It's like, no,
Right.
not at all.
Well, and then was it saying that for people that are already, with Compass, their splits stay the same, but moving forward, they were going to be restructuring
For a year. They're going to stay that way for a year is what I believe the article said. Let me
Okay.
let me quote this here. I don't want to misquote anything. So let's see here.
I thought it was like existing agents would get to keep what they had. New people joining on, if they had come from a higher split, they could keep that for a year.
They would keep that for a year.
and
That's
go-
correct. Yeah.
Yeah.
Right. After the first year, and then you would go to Compass's standard split.
Mm-hmm.
Yep. That's what it said. So and it's in line with other luxury brokerages, which I kind of know what that means. I'm not going to get into that just because I should know this stuff, or I wouldn't be doing my job. But that's kind of a separate issue. I mean, it's just I think it's unfortunate for the people that went there, and to me, we've seen these companies come and go in a lot of cases, and there's always these disruptors in the marketplace. And Compass was definitely a disruptor.
Mm-hmm.
They're kind of past that now. They're an established company. They're maybe not as sexy as they were when they came on the scene, because I think that was something I think one of you guys
Right.
had mentioned this. And it looks cool to work there. They got nice offices. I mean, what's cool to me is having the biggest number possible at the bottom of my tax return. That's how we look at things. But I think now they're going to have to compete with the people that have been there, because they're not the new brokerage on the block anymore. When you got companies like EXP and these cloud-based brokerages, kind of going that direction as well. That's at least my take on this, is that the honeymoon's over.
Mm-hmm. I agree.
Reality sets in.
So do you think they're going to rebound from this? Like, I mean, what do you foresee happening here? I mean, I'm pretty clear. I have a feeling they're going to get bought.
Yeah, I didn't think that, but that makes sense. They could totally cash out, be bought out, and they sail off into the sunset.
Yeah, I mean, the language that was used in the earnings call with investors does not sound very positive.
Yeah.
So I feel like they're almost setting the stage for, something might happen here.
Well, and when you take other people's money, meaning like a venture capitalist or an investor,
Yes.
they don't look to hold on to these companies.
Right.
They want to sell.
They want their money back.
Well, they
too.
want to get their
Yeah.
money back and the return,
Yes.
and there's usually a period there. So
Right.
I would not. That's. I mean, I'm just looking at what I know. I don't think this isn't any insider info. This is just the basics of what people do when there's like VCs that come in and those sort of things.
Mm-hmm.
Who do you think buys them?
Oh, Zillow.
Zillow?
No, I don't know. No, Zillow's going through their own mess. Good question.
I would argue Zillow is probably going to be a buyer, or not the entity that's purchased. But that's so they could buy them for sure. I don't know if this would fit their model though.
I don't have a good guess.
Well, let's see what happens. I mean, I would be surprised if this isn't even happening right now. And look, I mean, now they're primed for a purchase because their stock price is so low. That's what really counts. So, all right, why don't we take a break here? Enough talk about companies that are having challenges. I think everyone's having challenges right now. That's just how you look at them. I see opportunity, like we all agreed here. We're going to take a quick break. We're going to come back. We're going to talk about the fall housing market outlook. Summer's not over yet. We're still in prime summer in August, but it makes sense to look ahead a little bit. This is Toole Time Real Estate Radio on WWDB 860 AM. I'm Tom Toole of the Tom Toole Sales Group at RE/MAX Main Line. If you're thinking of becoming a real estate agent in the greater Philly area, I have a special offer for you. Our team did $165 million of volume in 2021, making us the #1 RE/MAX team in Pennsylvania and a top 1% team nationally. Our agents love us because we offer them a successful career, a great life, and an unbeatable culture. Agents who've been with us for at least a year average 30-plus sales. Even our brand new agents average 17 to 24 sales a year. We offer proven systems and expert training. We help you set more appointments and sell more houses. Now here's the offer. If you don't have a real estate license yet, we offer real estate scholarships so you can get one for free. Check it out at realestatescholarshipprogram.com or visit the Tom Toole Sales Group at RE/MAX Main Line at tomtoole.com. That's tomtoole.com. Get more out of your real estate career, and remember the real estate golden rule. You always get more when you work with Tom Toole.
For the best local mortgage service and great rates on your money, look no further than Mortgage America. We've been operating in the greater Philadelphia area for 40 years with a focus on smooth, easy access to home purchasing. Whether you're a first-time buyer, upsizing or downsizing, or just refinancing, we have programs for you. We also have closing cost assistance programs and access to subsidized interest rates. Pre-approval is free, no costs or commitments. To learn more, visit our website at mymortgageamerica.com or give us a call at 610-439-8000. We always have a person available to take your call with around-the-clock human service. Purchase your home with the personalized, local service you find at Mortgage America.
Mortgage America is an equal housing lender. NMLS 128501.
Buying a home or already own one? We can help. I am Kevin Hamill from Alliances Insurance Agency. If you haven't reviewed your policies in the last 3 years, now's the time. New home buyers, there are a number of ways that we can help you get to that settlement table. Call us to find out more at 610-816-0043, extension 3, or visit our website, alliancesinsurance.com. Don't forget the S, it's for savings.
Have you considered a career in real estate? Do you want control over your income? Whether you have a license or not, call us today at 610-692-6976 or visit TomToole.com. Join our team, the Tom Toole Sales Group at RE/MAX Main Line. All right. We are back on Toole Time Real Estate Radio on WWDB 860 AM. I'm Tom Toole. She's Stacey Mitchell. She's Sarah Tymon. We've got Gabe behind the camera, and we all work at the Tom Toole Sales Group at RE/MAX Mainline, the #1 RE/MAX team in Pennsylvania since 2018. And we're going to give you the fall market outlook. So I didn't really prepare Sarah and Stacey for this. I've got 4 predictions for the fall market. And in my view, the fall market goes right up until like December-ish. And then so we're looking at really the next like 90, 110 days, I guess, or 105 days. I don't know if I'm doing my math right, but somewhere around there.
Sounds right.
I'll take it. Thank you. Well, you got 90 plus 15, right? So that would be 105. So we do give accurate closing cost estimates here, by the way. So, So I want to give you guys 4 predictions that I have. I've been really studying the market, and it's nothing that I don't think you're going to see surprising, but these are the questions consumers are asking right now. So one of the biggest things I've heard is that there's a housing bubble. The bubble's going to burst. Prediction number 1, prices are going to continue to increase through the end of the year.
Agreed.
Totally agree.
All right. Tell us why in maybe 30, 60 seconds, why you agree.
Because there's still a lot of competition that's going to continue to drive up the purchase prices on the homes. I'm still in multiple offer situations, and we still go over asking price for most of the offers.
Love it. Sarah, do you have anything to add?
Yeah. I mean, I think absolutely everything that Stacey just said there. And we know that just people beyond us, people that are much smarter than us, who have, really looked into this in detail, are giving predictions of 10% growth here. So when you give the lack of inventory that we still have, we've talked about how, nationally, you may have like a 3-month supply. We're not at that here yet. The fact that buyers are starting to come back to the market more, I think when you compile all of those, that leads to increases in prices.
Well said. Could not agree more. And everyone's predicting this, by the way. This isn't just us. I still believe in the prediction because a lot of consumers don't think this is going to happen. And there's so much noise out there in the marketplace, like we talked about earlier in the show. Second one, a little more controversial here. So this is going to be a little more debate about this, I would imagine. Mortgage rates are going to stabilize and settle in the mid 5% range.
I still think it's going to be a little bit higher. I don't think it's going to be up to 7, but I'm still thinking low 6s.
Well, I think with the inflation rate kind of, it took a little dip. Mm-hmm. Not that that's going to hold, because I know a lot of people, they kind of changed the way that they were living, not driving as much and So,
Not leaving their
which
house.
I don't know how that works because we drive all the time, right, Sarah?
Right.
So yeah, not leaving their house. So the inflation rate could go up a little bit more, which it could tick up. But I think that it is more stabilized. So that being said, maybe the Feds won't continue to raise the rates. So maybe and I believe that the mortgage industry, they know that they can't continue to increase mortgage rates. They saw what happened to their mortgage applications. So I think there's a real concerted effort to keep the housing market solid because it is what got us through COVID. It was the housing market.
Agreed.
That was the economy.
Yep.
So I think it's going to stabilize. I think they're going to stay around this, and the buyers are going to come, they are coming back into the fold because of the little dip in the interest rates. So I think it's going to play into a really great fall market.
Right. And I think the realization that they're not going to be plummeting again anytime soon,
Right. And that happened for a specific reason.
Right.
The reason why those rates are not coming back.
Right.
So
Right.
people who think that that's normal, the high 2s and the 3% interest, no, that is not normal.
Right.
We
that's
might
gone.
never see that again.
Lowest rates since they've been recorded since the 1940s. And so I could see it going a little higher, Sarah, to your point, creeping up a little bit. I after that last Fed meeting, what I like watching the comments afterwards. I like reading the comments afterwards. I don't watch the meetings. But what I saw was we're fighting inflation. We're trying to get that under control, and we think we might have done it. And, this is a weird time of year to even gauge that because you have all the, there's so many people that are not around right now because school's back in session in a week or two. I know there's a big lead up to that, especially for the parents like myself. So I anticipate that we're going to see that maybe things did creep down a little bit. And because to your point, these lenders, they cannot go up higher on the rates or people. I think it would be bad for the market if they jump into the 6.5 range or 7 range. That's going to scare off a lot of buyers. So that's what I'm most concerned about. And I don't get the sense the Fed is worried about the long-term dollar. They feel really good about where we are long-term. It's this short-term inflation that they're trying to fight. And unfortunately, part of that is this supply chain issue that keeps ongoing, that materials aren't here in a lot of places. So everything's a little more expensive with these shipping containers sitting off in the Atlantic and Pacific Ocean. So that's a challenge too. What I also know from, Lawrence Yun, the chief economist of NAR, he thinks they might have stabilized, and we saw them jump up a little bit, I think prematurely in June. And if we continue on this path, they might even decrease the rates at the next meeting. So that, and 5.5 is pretty darn good.
That's really good.
And it's I think the challenge we're going to see here, and this is why realtors should really be listening, is you hear those bozos out there saying, marry the house, date the rate. I had a little rant about this. I don't know if you guys
That
saw.
was awesome.
Thank you.
That was great.
But I think it's because you can't just guarantee a refinance that it's going to be lower than 5 or 5.5%.
Right.
I've been doing this long enough. I've seen rates in the 7% range, and that even scared off people a little bit. You were talking about double digits when you bought your first home.
Yeah.
So that's why I think they're going to stabilize because of all these factors here. So it sounds like we're kind of on the same page, maybe a little bit of a bubble up on your end, Sarah.
Yeah.
All right. Number 3, inventory will come up and cause buyers to come back to the market. I'm not saying there's going to be tons of options. I'm saying they're going to be on the market a little longer. There's going to be opportunities for people to make bids, and they're going to have a little more time, and it's going to cause people to get excited again about real estate instead of feel beaten down.
Yeah, I would agree with that. I think that as the inventory does start to creep up a little bit and you see things stabilizing on different areas, more buyers are going to come out, and we're going to be not in any way in the situation that we were, over the last year, 2 years here. But I think it's still going to be a fast-paced market because as more stuff comes up, more buyers are going to come out.
So it kind of balances itself back again.
Yeah.
The whole thing is moving up at the same time, right? You have
Exactly.
inventory, but you still have buyers coming in,
Right. Right.
So it kind of feeds off itself there. But yeah, I do think that the inventory is going to increase a little bit more. We've been seeing that. And there is so much opportunity on the market right now. Things are on a couple of days longer as opposed to just one weekend. You might find something that's on 6 days and there's still
6
not
days,
an offer
wow.
in hand. And you're like, oh, let's go see it. You love it? Okay, offer's going in right now. So I think I'm excited about the fall market because I believe all these things. I'm seeing it happen. So, but I do think buyers are going to be abundant in the fall. I think they're still going to be there, and we're still going to have a robust market.
Yesterday, for the first time, I saw an investment deal in Philadelphia on a home that I was like, man, maybe we should buy this. And that's the first time I've seen this in a while, where like there's positive cash flow, 25% down, all the normal thing. And it's, there's a lot more that goes into it just through the numbers work. But that's the first time in a while I've said, the numbers really work on this. And I think that's a great indicator of inventory. And it's more of a transitional neighborhood than like an end user, because I think the end user neighborhoods are always the most competitive. That was something, and you can't quantify that in a stat except the rate of return you would get on your cash. And I was calculating 18%. So, it's not a.
That's good.
It obviously there's a lot of other factors there, but that wasn't happening. So that to me is a good indicator of inventory. And this home already had a price reduction made to it.
Oh my god!
And it was on the MLS. So
wow,
something to think about. Last one here, right on time. The normalization of contracts, specifically inspections are elected the majority of the time. Normal deposit amounts in normal timeframes, meaning like within 2 or 3 days, not within 10 seconds of executing the contract.
right.
5% deposits, which were kind of the norm. And a lot of people would put down less in past instances. I'm big on the 5%. A normal closing period, not as many lease backs. The things that we saw before 2020 are going to be the norm in the agreements of sale that come through.
Yeah.
Yeah, I agree. I've written some normal offers.
What is
unquote.
normal, right? It's
Normal,
philosophy
like you
here.
said, inspections. I'm trying to think if it was if we elected inspections, but without tossing a little bone, like buyers accept the first $5,000 or something. But still, with those inspections elected, which is amazing, you know. Yes, normal, 45 to 60 day close. It's kind of
everybody's
exciting.
not like scrambling.
Right, exactly.
Yeah.
Negotiating the inspections.
Right.
Yeah.
Negotiating the offer price even. I mean, maybe homes are selling at 98% instead of 102%. And I like what you said there, Sarah, about the time. These deals going so fast made the transactions not that great for buyers and sellers because you're trying to do it so quick because everyone's trying to move fast. I like having a little extra time in there to make it easier for us. I don't know about you two.
Oh, yeah. I mean, with how fast-paced the transaction was going, I mean, this also speaks to, work with people that you know, especially on, the lending side, that you know can, get these things done and get the pieces in place. But all of the things that would have to happen by, tomorrow, and that was every day. And now this next thing is, you know what I mean? There's no, just all right, you have a second to breathe. It was so, you're running from the second that you get that offer accepted.
So, sounds like we're in agreement on all 4 of these, except maybe the rates. Time will tell. We're going to keep track of that one here. We're getting played out. So, thanks, everyone, for tuning in. This is Toole Time Real Estate Radio. If you want to follow Sarah, she's on Instagram at Ty_TyTime. That's with a Y. You can follow Stacey at the number 2 Mitchco. You can follow me at Tom Toole 3rd at Tom Toole 3RD. And we're streaming live every single week on Facebook, YouTube, Instagram. Make sure to subscribe on our YouTube channel. Click the bell for the reminders and the alerts. And we'll be back next week, 3 o'clock on Tuesday on Toole Time Real Estate Radio on WWDB 860 AM.